You're listening to Real Estate for Real People, hosted by the Stone Sisters. The Stone Sisters have built an award-winning realty business, and they're here to share some of their knowledge with you. A new episode drops every Thursday. If you enjoy the show, please share it with a friend and leave a review wherever you listen to your podcasts. And visit www.stonesisters.com for more information just like this.
Hi, welcome back. Thank you so much for tuning in and joining us today. Here is another episode of Real Estate for Real People, and I am really interested to have this conversation today. So thank you so much for joining us. Today, as our guest, we have someone talking about commercial real estate. So Nick Renton, you are with William Wright Commercial.
That's correct,
So we're going to talk about, your company and the company that you're with, but we also want to sort of dive into the commercial aspect of real estate here in the Okanagan market. So without further ado, maybe you can talk a bit about yourself. Tell us, you live in the Okanagan. Have you lived here for a long time? Give us a little bit of a background.
Yeah, sure. So I actually grew up in Vernon. So my family moved out to Vernon in about 2001. I've spent a lot of time across Western Canada. I was born in Calgary. I did some schooling in Victoria, and that's where I met my wife and had our first daughter. And then we moved back out here in 2019. I came out for a role with a local credit union here, and my wife currently works for the province. So she moved out here in kind and worked remotely, which was super helpful for us.
Awesome, yeah.
We wanted to be a bit closer to my family who lives in Vernon and my parents as well, and experience the Okanagan lifestyle.
So you are the perfect consumer buyer, moving here, because everybody's moving here for lifestyle. So
Yes,
so interesting that we could probably just have a podcast topic of just about that. But so tell us a bit about William Wright Commercial.
Sure. So I joined William Wright Commercial in May of last year. So we're just coming up on a year for myself.
Yeah.
A big reason that I joined the William Wright group is we have the most dedicated offices of any commercial brokerage in BC. So what that means is we have feet on the ground in many different markets throughout BC. And we get to specialize in our specific segments of where we are. So we have offices in Victoria, a couple offices in Vancouver, Kelowna. We recently just opened a new office in Kamloops. And at the end of this month, we're opening a new office in Nanaimo. So we're going to be able to support a whole bunch of different regions. And it also allows us to have buyers and sellers from different regions use our network of people to really find new opportunities.
That's right. So you take on a new property or business that's selling here, and you can promote it to the Vancouver market.
Yeah.
Plus, two, to have that knowledge base of, okay, what do consumers that are selling businesses in Vancouver, go through versus property here in the Okanagan.
Exactly.
So great to have that. And I jumped a little bit of it ahead, but your background is quite interesting and is a really good complement to working in the commercial realm. So maybe you can kind of go backtrack to that a bit.
For sure. So when I was in Victoria, going to University of Victoria, I did my economics degree there. And at that time, I started as a teller at a charter bank in Victoria, and I worked my way up through that. So over about 11 years, I did various roles there. But the last about 7 years, I was working in business and commercial banking. And so I did small business advising for new businesses, existing businesses, growing business, and I specialized in structuring lending for them.
Amazing.
So it gave me a lot of experience in working with commercial real estate, whether it's for leasing, whether it's for purchasing, and understanding what that person is going through when either they're buying a new building or they're starting a new business, and how to open the accounts and how to go through financing terms.
Right.
And also, what to look for when it comes to potential improvements to the space if they're a new lease. And so it gave me a really strong depth of experience to give advice on a lot of the clients' needs. And that's translated very well into my new career within commercial brokerage. Because I have a lot of clients that come to me looking for space, and I've been able to give them quite a strong feedback of where to look out for, what to really hone in on, and what to expect as they're going through the process, so that they're well informed and can make decisions in advance without having any sort of additional stress on them.
So nice. Yeah, that's a great service that you can provide to them. So how is overall the commercial real estate market here in the Okanagan, would you say? Is it robust? Is it strong? Has it taken a downturn? Our market, residential has taken a bit of a shift. Has the commercial side of things?
It's been interesting. I think sometimes it depends who you ask. I believe the Okanagan market has been extremely robust especially through COVID, but coming out of COVID as well. as we've talked about offline, there's a lot of people coming to the Okanagan. And from what we can understand, that's not slowing down.
No.
And quite often what happens that we've seen in the market as the populations start to grow, commercial business and commercial ventures follow that. So as the population grows in certain areas, it breeds the ability to bring more business to the city or to the region or whatever it might be. And I think at the same time, as the residential population has increased, the commercial inventory for product, whether it's retail space, office space, industrial space, whatever the different asset class that you're looking in, it hasn't caught up in the same supply. And so we've seen a considerable amount of demand remain because the supply just hasn't caught up to that demand.
Right.
And so I wouldn't say it's as strong as it was last year or the year before, but I think that's more specific to the interest rate environment and economic environment. But we do have a large stable of buyers or investors that are still looking at the Okanagan as a really hot market and a really important market for their business. And we don't really see it slowing down too much. What we definitely have seen is an increase in leasing transactions versus true purchases of new buildings or new land or investments.
And is that lease as far as office space? Because of course that's something that, you hear in these big city centers that, COVID happened and everybody moved away from the downtown cores. And now slowly people are coming back to those downtown cores, but not to the same degree that they were. Are you finding that there is still a high demand for lease space, or what does that look like in the Okanagan?
Yeah, I think COVID shifted quite a bit of how office space is seen for both a business and the amount of space that they do need, but also as an employee or a contractor or somebody starting your own business, you can determine where you are working from a lot more than you could before. So that's a big thing the Okanagan has seen is there's a lot of people that have come here to do remote work, whether they work from their home or they might use a shared space in Kelowna or what have you. And that's changed the dynamic of where people consider their home base. I think people are definitely starting to move back into work from work environments,
Yes.
Bring the employees back to the office. I know Vancouver has seen a reduction in their office inventory a little bit, so they're starting to see some more spaces fill up. I'd say in the Kelowna, the big thing that we have a lack of inventory when it comes to A-class level office space. We're also seeing a large build out of new industrial space on the north side of town, closer to the airport, and those sort of the northern side of Kelowna. And then obviously retail space is also in smaller demand. There's not as many large shopping centers in the Okanagan as there may be in, say, in Alberta, where they have a bit more land to stretch those out.
Right. Makes sense.
And so there just hasn't been the same build out of commercial space really across all asset classes. And so what we're seeing is there's still a large demand for quality product. There's product that is available for the right tenant. But in terms of high demand product that's priced well, it goes pretty quickly.
Right. Okay. And that makes sense. We have more and more people moving here, and we probably never had a huge amount of commercial supply. Really so really even with COVID and people moving to their homes, it wasn't enough to fill that. So interesting. Where are you finding opportunities in the market? Is there opportunities in the market?
Yeah. Well, it's something that all of our clients come to us to ask, where would you put your money type of thing.
Or we get people saying, we want to move to the Okanagan for lifestyle, as we talked about. It's such a great spot. So now what can I do there? I need to help me buy a business. Yeah. We get that often, and then we just send them your way.
Exactly.
I'm like, we can help you on the house front, but.
Well, I think for that question can be answered a few different ways. It really depends on what people are looking for. In terms of investment in the city, I would say with interest rates that have increased over the last little while, it's really made an impact on the investment market for commercial space in Kelowna. It's harder to finance projects. The lease rates haven't quite caught up with the cost of financing, and also the expansion of the property values that have happened in the last 2 or 3 years.
Right.
So from an outside perspective of, say, somebody as an institutional investor or a large land property owner that's coming into the market to look for opportunities, you start to have to look to assets that aren't quite that maybe have been leased by the same tenants for quite some time, and there's potential to increase rents. Some spaces that may need some capital work for renovations, but if you have the capital and cash to do that, you can improve the quality of the building and attract different and more valuable tenants. And then in terms of the other side of that, where I dealt with a lot at the bank is owner-occupier businesses.
Right.
So what that means is you have your business occupying either all or a portion of a commercial building. And what that allows you to do is if you have a bigger building that has maybe 2 to 3 units in it, you can locate your business in one of them and then lease out the other spaces.
Right.
That gives you a lot of cash flow flexibility. It gives you a lot of financing benefits because lenders typically look more favorable on owner-occupied properties. So we have seen some more value, I would say, on the owner-occupied types of properties.
Right.
Just
Interesting.
because they can have more flexible financing terms. The cost of the building is important, but not as important as it is to an investor, because if they can see value of their business increasing revenues because they're in a location, they don't have to look at the, does the exact number of this lease rate make sense for the financing for my investors and so on.
Well, and it's also, too, you become your own tenant.
Yes.
So who are you going to rely on more, yourself or someone else? So you might as well be your own tenant, which we've always said. And it's just the same as in residential. Either you're going to rent or you're going to own.
Yes.
So it's that same sort of idea. It's just more in commercial if you can find the spot.
Yeah. And to sort of pick off that, a lot of the conversation and a lot of questions that we get at William Wright is, should I lease or should I buy?
Yeah.
And that is really dependent on the type of business that you are, the stage your business is in, and potentially the access to capital you have to either renovate a space or purchase a building, and understanding how that'll affect your business. So for most clients that are just starting out in a brand new business, again, depending on scope of that business, it's typically more advantage to them to do a lease because it gives them the flexibility to start at their business. You can choose the term. You don't have large financial obligations or capital injections into these businesses. Where we see most of the time is if you're looking at a lease versus buy situation is this a business that you're going to be running for the next 5 to 10 years or longer?
Yes.
Do you want to tie this transaction into the assets of your business for future sale, for retirement and that type of thing? But there's so many variables that come into that it's not just a simple you should lease or you should buy. It's where we provide that advice is sitting down with the client, understanding the trajectory of their business, understanding their capital ability to invest in properties, access to financing, and then providing them with the information to make the decision for themselves.
Yeah, makes sense. I love that.
Yeah.
So when you're looking at the commercial sort of realm in it, so when we're looking at commercial properties and we're following, it's different than the residential market. So looking at rents, and you had sort of keyed on this and just sort of said, the rent amount, can that change? I mean, we've got pretty strict restrictions as far as residential rentals, the vacancy and all of that. What does that look like on the commercial front? Can your rent just go up? Is there any regulations on that?
Yeah. So it is something that we have to talk about a lot. So there is no rental caps when it comes to commercial real estate. The big difference on commercial real estate, and it's especially somebody that's new to either leasing a space or, as a landlord, potentially letting out that space to a new tenant that's coming in, is typically the lease terms can go anywhere from 1 year to, depending on the tenant, up to 15 or 20 years.
Right.
And so what you do at the start of that process is you work with the landlord to determine potential escalating rates throughout the term of your lease, so that at the end of that term of the lease, you're not hit with a substantial difference from where you started 5 years ago to where you are now.
Right.
That being said, it still can happen because if lease rates increase substantially during your term, similar to what mortgage rates have done recently, where you renewed at a certain time 5 years ago and all of a sudden those rates are considerably higher.
Right.
You are at risk to that. Where we provide the advice is working with the clients a couple of years or, potentially depending on the term, maybe 6 months before their lease is up for renewal, to provide them the information of what market rates are now, what you should be looking for in the renewal terms, and understanding the impact of potential rate increases or, cost of operating that building so that they can plan accordingly. That can either make them move to a different location if they realize there's potentially a different spot in town that they can go where they can get more space at a more affordable rate. It might give them that opportunity to move at the end of that term.
So there's no real, somebody could lock in and say, okay, we're going to be here for 5 years. We're going to spend on improvements to this property. And in 5 years, their rate might escalate substantially.
That's
and
correct.
then they decide, okay, we can't afford it. We need to move on.
Yes.
And they've already spent all that money on improvements. It's so crazy to me. Like it's
definitely something that is a bit jarring for a lot of people that step into the market. And where we try to provide, again, the advice is understanding the trajectory of their business before they step into the lease. Because if they're going to go and spend potentially $200,000 to $300,000 of their own cash.
Is that normal? Like what is a normal?
It really depends on the space.
It depends on the business, I guess.
And I say that a lot. It depends. And it really, the reason I say that is if you could walk into a 2,000 square foot unfinished shell space in a brand new building, and it could be used for a restaurant.
Right.
That restaurant potentially could spend up to $1 million in total renovations to whatever they want to turn that space into.
Right.
They're obviously, if they're going to drop that much cash into a project like this, they're going to be looking at a lease term at a minimum of 10 years.
Okay.
And then they'll likely be adding a renewal clause into that so that they have the opportunity to ensure that they can renew. Now, that renewal may happen at market rates 10 years down the road, but they get the option where they control whether they stay in the space or not, as long as they're agreeable and up to date with the landlord.
And if it's at market rates, then at least you know you're going to be paying fair value. And if you move somewhere else, you're going to have to still pay fair value.
Yes.
So,
and on the same side, there's an incentive for the landlord to keep the tenant if they've made improvements and the business is functional and they've shown the ability to pay the appropriate rates, because there's a cost to the landlord to release the space should somebody leave, whether they have to strip all of the fixtures out, pay for brokerage fees to bring a new tenant in. If it doesn't get leased for 6 months for some reason, that's all costs that can be understood in accepting a potentially lower rate to an existing tenant. So the tenant does have a bit of not leverage per se, but they do have an ability to work with the landlord and create a beneficial connection between the two parties versus having to say, hey, I'm going to go build a new space that's going to cost me more money to do all this, but it's also going to cost the landlord a lot of money to release the space as well.
Well, and something so nice to be a landlord and be able to just have your property, know for 10 years, you don't even have to touch it, think about it. You've just got the rental coming in.
Yeah, exactly.
So with that, is there a market for just buying commercial space, renting it out? Is there, I don't know, we don't have to talk specifics as far as cap rates and that sort of thing, but does that make sense right now?
Yeah, it's one thing that I would say has been the hardest conversation to have with a lot of potential new buyers and sellers of properties. The cap rate is a tool that commercial brokers use as, I would say, probably like the most general term of how we can price a building. The cap rate is, to not get too nitty gritty, it's basically the net income from the property versus the potential purchase price or the value of the property.
Right.
And that cap rate, depending on the quality of the asset and the location that you're in, can vary considerably. I like to look at the cap rate as a similar conversation to talking to someone about GIC rates at the bank.
Right.
So if you're looking at a short-term GIC that's fully secured, 1 year or something like that, it's going to have a lower rate of return because it's relatively secured. You know the type of tenants. There's not a lot of upside to the potential increase in income for the space. But if you want to lock in for a longer term, you think that there's more value of holding this thing for a longer period of time, or there's a potential increase in the risk of that GIC. Maybe it's at a non-chartered bank or something like that. It's a GIC offered by a potential third party outside of our standard financial system. You're going to have a potential increase in return because there's more risk to that.
Right, of course.
So I try to connect those two.
Makes sense.
Now, each market is different. Some investors come in and they're satisfied with a 3.5% to 4% cap rate because it provides them confidence that their investment is going in. There's strong, steady returns to that business that are the tenants that are in that building.
Yeah.
They've understood that, this is more of a cash flow thing for them, and they have investors that they have to satisfy. And then there's, depending on the markets that you're going to, the higher the cap rate, the more risk to the building. There may not be as much upside for the income. You may be relying on capital appreciation of the building that may not be there.
Right.
And so the sweet spot that we have found in the Okanagan is a little bit more variable, but probably between 4% and 5%.
Okay.
Again, depending on the type of investor that you're looking for, depending on a whole bunch of different factors, but that's, the common feedback that we get.
And does that change? Like if you look and compare that to Vancouver, is that quite a bit different, or do you know, or How does that look?
So in Vancouver, because of the property values that you see there, typically cap rates are considerably more compressed. So you'll see more of a 3.5% cap rate or potentially lower, depending on the type of property that it's in. With interest rates that have been skyrocketing over the last year, those cap rates have been shifting quite a bit. But typically the Kelowna market was a really big investment market for the last 2 years or 3 years. What we're seeing now is we have a lot of investment inquiries for our Kamloops market, Northern Vancouver Island, Nanaimo, and those types of areas, because they still have, in relative terms to other areas, compressed property values. So those cap rates are a little more palatable to investors.
So let's dive in a little bit to the process of buying commercial real estate. I know it is different than residential real estate, different fees, different regulation. The offer's different. So deposit, all of those things. So, I'm like, as I start going, I'm like, wait a second, there's a lot of things that'll be different here. But maybe we could talk a little bit about that. So start to finish, kind of what's the process overall?
For sure. So one of the big reasons why I got into commercial real estate potentially versus residential real estate is I really liked the fact that
you didn't want to have to wear a white suit and be a stone sister.
Well, I'm wearing white today,
That's
so
true.
I tried to keep up. But what it was is it's not as emotional when it comes to the type of process that you're about to enter into. Typically, when somebody's looking into their next home, whether it might be a forever home or a stepping stone to the next part of their life, price is important, but quite often emotion can potentially play a part in whether 100%. They want to make an over-ask offer or they decide not to move forward with the property. When it comes to commercial real estate, it's really about numbers, mainly because if a business owner is about to invest a bunch of their own capital into a new business or a new property, they want to make sure that that capital is going to return for them.
Right.
And then same for an investor. Like if the numbers don't make sense, they don't make sense, and you move on.
Right.
Now, when it comes to the process itself, we typically, it's obviously very different for a buyer or a tenant or a landlord or a seller. On the buying side, what we try to do is explain the process to the client upfront. So we say, these are the types of things that you should be expecting. On a commercial property, think wedding. Commercial is more expensive. Whenever you say wedding, things become more expensive.
For sure.
So anytime you talk to an appraiser, anytime you talk to a lender, anytime you talk to a building inspector, it's not that they're charging more for their service. The service is just more in depth. There's more required from them to be able to satisfy their respective requirements to help you purchase this property.
Okay, really good point.
Yeah. So there's more legal process because there's more contracts to review. Yep. If there's leases in the building, you want to understand the financials, everything. And then on a building appraisal, typically the buildings are more of bigger scale, again, depending on what you're buying. But then on the appraisal side, they're also factoring in different values to how to approach the value of the building. And so, for example, on a commercial appraisal, they might look at comparables. They might look at the potential income from the property. And then they also have a replacement cost. And so they're saying, if this were to be rebuilt at a specific cost, what would that be to you? And then they blend those rates together. Right. That's a very grand overview.
No, but it's good. Keep it simple.
Yeah,
it's
but
good.
they have more value that they have to provide in that appraisal. And then same with the building inspection. Typically, because you're in a commercial space, there's more power requirements, there's more load requirements, there's more everything requirements.
For sure. And so, depending what you want to do with the property, you're going to need different things to be looked at. Yeah. Makes sense.
And because of that additional work that those professionals have to provide, the timelines for the process are typically quite a bit longer for condition period, but also in potential closing of a transaction.
Right.
We might see some potential land transactions take up to a year to close because of the appropriate due diligence required by the developer to go through their permitting, their building plans, zoning potential.
I was just going to say zoning.
All of those different things. And they want to make sure that they can take that across the line before they're going to lift conditions or whatever that might be. And then there's other instances where if it's a standard turnkey business and a client is like, hey, I can move into this next month. I've done some leases where it's taken 2 weeks.
Right.
And so it's really, again, depends on the types
business.
of businesses that you're looking at. But what I try to prepare my clients for the most is that, one, it's going to be a bit more expensive than a standard residential process. And this is for both leasing and for purchasing a property.
Right. Yeah.
But also just understanding that what we're looking for is the future use of the building and how it's going to benefit your business. With the residential side, typically you have, here are your options. Here's your parameters. Yep. Help me find a couple of those different options. And then we can, make sure that these will be either in your benefit for the time that you want to live in this space, or show you how you potentially upgrade the property to live there for a longer period of time. And I'm not telling you, what you guys do, but I think it's the parameters of commercial is a lot more client dependent versus property dependent is kind of what I'm
makes sense.
leading
Actually,
towards.
that's a great way to classify it.
Yeah.
Totally makes sense. And then deposits. So how do deposits look? Because, typically for residential, you don't put a deposit down until you've done your due diligence and you remove conditions.
Yeah.
Conditions are typically on for 2 weeks.
Yes.
So whereas I know commercial side, as you just said, can be a year. So how does deposit work? Typically.
So, typically.
I know it depends, but.
So for example, on a lease transaction, a deposit is usually due 2 to 3 business days after either your conditions are removed or a signed lease agreement has been completed.
Right. Okay.
Now, depending on the scope of that lease and the size of the building, you might have a staged deposit. So there might be, you put X amount up for the first part of the transaction, then you remove conditions and you release a second amount of the deposit. On development projects or land or larger commercial buildings where there's a lot more due diligence, there could be potentially up to 2 to 3 different stages of the deposit.
Right.
And then also refundability with those deposits. As you get to certain points, those deposits no longer become refundable.
Right.
And
of course.
again, each contract can be a bit different, which is why it's exciting for us, because some of the fun of building out these offers or as a seller of a property is there's so many different ways that you can structure that for both the benefit of the seller or the purchaser. But yes, typically deposits can be a bit more complex when it comes to commercial real estate. Now, in terms of amounts, again,
it depends on the value of the business.
Depends on the value of the business.
Makes sense.
It's not a cookie cutter 2% of the purchase price or 5% of the purchase price. It might be, we want to tie up this property for a year, so we're going to have to put up a more substantial deposit to do that.
Right. And I'm sure to some degree there's a little bit of say into what industry that business is. Maybe some industries have, because they typically take longer for that transition of the sale of the property to go through.
Yeah.
So that makes sense. Square footage. So when you're leasing, is there an average, like, of course, for residential, we can say the average, house price right now is $1 million. Yeah. Is there an average, such a thing as an average price for commercial? For leasing,
so
maybe?
When it comes to average pricing for leasing, it's asset class dependent. So, it depends. I feel like I'm going to say depends 100 times.
We're going to label this podcast, It Depends.
But it's and we've talked about it before. There's 2 aspects, especially on a lease square foot price.
Right.
So you have your base rent, which is, if you're in a retail space in downtown Kelowna, can range anywhere from $25 to $35 or more, depending on the quality of the building, ground floor nature of it, how close you are to something. Now, if you're in a industrial space that's on an older building in an area of town that might not see the same traffic, and it's more for potentially storage in a yard or something like that, you can get down to as low as $12, $13 a foot.
Okay.
Now, the additional part on the leasing side is a thing called triple net or additional rent. So on the commercial side of transactions, instead of charging a base rent, they typically charge base rent plus the cost of operating that building. Now, that can be things like power requirements. That could be things like HVAC use. That could be things like insurance, interest, property taxes. And those are all blended into an additional rent amount per square foot.
Now, and is that the amount, is that disclosed on the listing? Or is it just the square footage that's disclosed really on the listing, so you have to dive a little deeper?
Yeah, so on the publicly listed documents, it's only the price per square foot for the base rent.
Okay.
On the brokerage side, we see the additional rent component, but we don't see how it's broken down. We just say it's $9 a foot or $11 a foot. And the one aspect of the additional rent is it is a variable amount year to year. So if the cost of a building operation goes up, property taxes go up, insurance rates go up, that gets factored in.
And is there a cap on that? Can it go up? So there's no regulation on that. So that can go up whatever. Now, do you have to prove, okay, wait a second, insurance went up huge amount, or okay.
Yeah.
So it's going to be within reason.
Exactly. And where it becomes interesting is when you have multiple units in one building, it's a pooled amount split based on the allotment that you have within that building. So there's an incentive for the landlord to make sure that those costs are minimized as much as possible because it affects everybody in the building.
Right. And
so
you
they
don't want, as a
yeah.
landlord, have everybody leave.
Exactly.
So you're going to keep it. But interesting. So if your price that it's advertised is $22, but your extra fees are, your operating costs or what have you, are $9, really, that changes things drastically.
Considerably. And then in addition to that, all commercial real estate has GST. So
right.
Yeah. So on the monthly lease rates, in addition to additional rent and the base rent, it's multiplied by 5% for the GST. And that's also a great point to bring up for commercial property purchases as well, because all commercial property purchases include GST as well. And so that's an element.
Or plus GST.
Plus.
Yeah. No,
correct.
sorry. It's just, yeah.
Yeah. Plus GST. It's a great point. And where a lot of people forget about that, if you're buying $1.5 million, $2 million property, 5% on that is a considerable amount of money.
Absolutely.
And so we always refer our clients to the appropriate, whether it's accounting or legal advice, to understand the implications of how that affects their tax planning.
Right.
Because there may be ways where they have to come up with it at the point of sale, or
they
defer
can defer
it to the next year, depending on the scope of their business cycle, or the reporting of that GST to the government.
Okay, interesting. Okay, I have one last question, then I'll let you go. I'm so sorry. I've taken up lots of your time.
I love talking about this.
It's so interesting. So I think the one thing that's come clear to me is you definitely need a realtor, a commercial realtor to help you. This is, residential realtor, we won't be able to answer all these questions. So certainly they have to give you a phone call.
And we know we have our line in the sand. We are not residential experts. We specialize in our commercial, and we trust our partners on the residential side to be able to provide the appropriate advice for those, because there's many things on the residential side.
It's very different. The two sides are really different. So I think that's the key, is make sure that you have a trusted advisor. We highly recommend you guys and your firm. So, I think that's a big component of it. One last question. If you have a property, and this is something that, we come into contact with quite a bit because we're on the residential side, clients will contact us and say, okay, we run our home business. We run our business out of our house, and we want to sell the business. We want to sell the house. We're going to sell this together. Looking at the GST component of it, does the GST take over the whole value, or do you split that, or does it depend?
So the commercial broker hat of me says, please refer to your appropriate financial advice.
Right. Yeah.
And accounting
advice. Yeah.
But mainly because depending on the scope of the business allotment of the total amount of that property, it can play a factor in whether or not it's considered a commercial transaction, or how you claim the potential gains for that.
Right.
Because as you know, on the residential side, there's capital gains allotment for exemptions for lifetime, that as soon as you start adding in the commercial aspect of it, potentially removes quite a bit of that option to defer those taxes or remove those taxes. So what we try to do is there a way that we can either sell the business itself on its own and keep the property separate, or is there a benefit for, doing it all and, because it might increase the value of the business that offsets the tax.
Absolutely. And probably that's true.
Yeah.
That probably makes sense to sell it on that commercial realm of it. So
and on the commercial side, what we see quite a bit of is, and what I advised when I was a business advisor, is understanding how to properly structure both your operating business and your assets. Because there's times where you purchase a commercial building, but it may not make sense to combine it with your operating business. Because if you were to go to sell that business in the future, you have everything in one company. It's hard to split out those assets at that time.
Makes sense.
And then if you decide to sell the business, but you want to keep the property, you can create a lease transaction between the new owner, or there's lots of different ways to benefit from keeping those assets separate, which again, we always refer to our legal and accounting partners that work with the clients.
Of course. No, that makes sense. Well, this has been so good. Such great information. Thank you so much for joining us. Where can people find you? If they have questions, they want to move here to the Okanagan, which hopefully you do, we will help with residential, but you will help them on the commercial side. So many people are wanting to move here for the lifestyle, and buying a business or moving your business here is a really viable option. So where can people find you?
So you can find our firm, William Wright Commercial in Kelowna, here at williamwright.ca. So that website will pull you up to all of our different brokerages that we have through BC. If you want to select Kelowna specifically, it provides a listing of all of the brokers that we have in our office. There's 5 of us currently.
Perfect.
And then if they're coming from or going to a different market within BC, it also lists all of the other brokers that are available there. And you can reach me directly at 584-5308.
Okay. Well, thank you, Nick. So for any of you that are tuning in and listening, this is Nick Renton. Thank you so much for joining us. We will post his information below in the podcast so you can reach out directly to him. Thank you again so much. And thank you for tuning in.
Thank you so much.
Thanks for listening to this episode of Real Estate for Real People. If you want to reach out to the Stone Sisters, visit www.stonesisters.com. This podcast was produced by Podigy Podcasts. See you next time.